a lot of people haven't been able to navigate. They've tried to buy the dips early in February, and then they got ran over, and then they tried in March, and things deteriorated even more. So I think for the long only portfolio manager, it's been a 5. For the retail investor, I think it's been a 1. I think it's been exceptionally hard. And I don't say that mocking them. I'm saying it because it's actually very true. It's a very hard market.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. It remains a whipsaw year for investors as both stocks and bonds are now up materially from their late June lows. So is this the all clear? Will prices rise further over the remainder of the year, or is this a classic bear market rally, one that lulls the bulls back in before returning to maul everyone? In uncertain times like these, it's wise to tap the counsel of those with decades of long-term success in the markets. So today, we'll ask these questions of Thomas Thorton, former portfolio manager, senior trader, technical analyst, and now founder of Hedgefund Telemetry. Tom, thanks so much for joining us today.
Well, thanks for having me.
All right, Tom. Well, look, I got a lot of questions here for you, but let's just start at the very high level. This is the question I ask all my guests at the beginning of these interviews. What is your current assessment of today's global economy and financial markets?
Well, we're coming out of a very different period that you can't really characterize and look back and say, well, this pandemic was just like the previous pandemic. We had such a wide amount of disruptions around the world. We had let's just go through it. Lockdowns, you had supply chains disrupted and broken. And I think we're still working through that. On top of it, we had the Fed and every central bank in the world stimulate like crazy. And I think it's really fair to say they overstimulated. And now they've caused an inflation boom that it's hard to put the genie back in the bottle when we're talking about inflation.
All right, so a lot of factors that we haven't seen for a long time. They happen to all be hitting at once. You just said sort of the genie's out of the bottle here, so it's going to be hard to put back in anytime soon, despite the Fed scrambling here now, finally, hiking rates as fast as it can. So, your expertise is in portfolio management, is in trying to trade the markets that you have, not the markets that you wish you had. This has been a really challenging year for investors. It's been one of the worst starts to the year for both the stock and bond markets combined, making it a relatively unique year. So your service is basically helping investors navigate this and try to survive it as best they can and potentially make some money if possible. And I want to get quickly to the public portfolio that you share because it's actually done quite well this year. But real quickly, based upon the kind of dog's breakfast of factors that you just mentioned there, kind of how unique is this year? How challenging is this year in kind of a 1 to 10 scale based upon the arc of your career here?
Right. Well, I come from a hedge fund background, and the main hedge fund I worked for, which was a $5 billion hedge fund, we were really quite good at navigating difficult markets. We were net short for many years, and those were years that the market went up. And in 2008, we had a really very good year, catching the financial carnage on the short side. I can't say that it was the year that we hit it out of the park, but we really we had a positive year. We survived. Our clients were very, very happy with us because everywhere else they were down 40%. What I'm thinking this market, and it is a difficult market, a bear market, a really, really ugly bear market gives you very few places to hide. So it's been very hard to hide in stocks. It's impossible right now in the bond market, and the bond market's been an absolute nightmare. And it's a silent scream because a lot of bond investors really don't see the carnage in prices that's happened this year. I mean, they're wondering why is my bond portfolio down? Commodities have been good, but they've been also rather choppy. And if you were in energy, you just saw a 20% drawdown off the highs, which I think a lot of macro touristy type people went into energy as they saw it booming, and they got into it rather late. Thus, it fell apart and came down. Gold, no. Silver, no. Bitcoin, no. You can't. There's no place really that's been able to hide other than cash. I mean, let's just be real straight. So I have had a good year, but I trade both long and short, and I also have at times had advised a large percentage in cash. And cash has done, it doesn't pay you anything, but it hasn't gone down. And it just leaves room for you to navigate when you see areas of when you want to buy or when you want to short into things. So I said early in January to my clients that it's going to be a tactical year where you're going to have these big moves lower. You're going to get bear market rallies that come fast, furious, and well before you want them to, if you're long, and people chase at the very end. And I think right now, we're here in August 1st, I think people are chasing this latest rally. Today, the markets have been choppy. They're trying to move higher. And it's, of course, the mega cap tech and Tesla and those names are doing the heavy lifting while breadth is negative. So that's a little bit of a concern for myself. So I'm really flexible in my thinking. I don't carry a lot of bias, even though I will say I worked for a fund that we were net short for many years. It wasn't really just fundamentals. I look at technicals, I look at market sentiment, and it's still a bear market in my opinion.
Okay, still a bear market in your opinion. All right, I want to get into in a bit where you think the trajectory of that bear market is from here. Before we get that, few other questions. First, I'm going to re-ask one that I asked earlier, which is just if you could put a ranking of 1 to 10, 10 being the most difficult and challenging, how would you kind of generally classify this market versus the ones that you've had to invest in and trade in your career?
Well, for me, I was trained in this type of market. I like this type of volatility. So for me, it's been a 10. I love this. Opens up opportunities because I use different indicators that spot exhaustion signals on the downside and the upside. Market sentiment has been up and down and mostly down. So it's a 10 for me, and it's probably a 1 for the majority of people out there because a lot of people haven't been able to navigate. They've tried to buy the dips early in February, and then they got ran over, and then they tried in March, and things deteriorated even more. So I think for the long only portfolio manager, it's been a 5. For the retail investor, I think it's been a 1. I think it's been exceptionally hard. And I don't say that mocking them. I'm saying it because it's actually very true. It's a very hard market. And, I make mistakes all the time. I'm currently short a bunch of stuff, truth be told, and they're underwater on a little bit on this bounce. So it's just, you can be wrong, but just don't be wrong for that long, and make sure that you size your portfolio properly where you don't have way too much into one stock or sector or asset class for that matter.
Okay, so I want to get to ask you some specific questions about the Fed and some recent comments you made about that. Is it fair to say that one of the reasons why it may be such a painful and challenging year for the average retail investor is that they have been sort of lulled into a complacency and a set of expectations over the past decade with all the liquidity that's been pushed into markets, propping up prices in the sense that if anything gets even remotely uncomfortable, the Fed's going to step in and try to ease all pain. And so people are kind of, they're trying to use a playbook that's worked great right up until now, but it doesn't work anymore in this environment.
I think that's absolutely true. We've seen the Fed come in at various times in the last decade, maybe the last 20 years. But there's one thing that we haven't had when the Fed comes in, and that's high inflation. So this inflation is off the charts, and it really makes the Fed's job so much harder. And again, the Fed, I mean, the Fed is not necessarily the end-all cure-all for the market environment. Many people are speculating that the Fed's going to pivot just because we've seen a few economic reports come out showing that inflation is starting to moderate. Yeah, I think inflation peaked with the June CPI report that was released in July. But I also think, and it will come down in the next week when the June CPI released in June. Okay. The July CPI will be lower. But I think the problem is it's going to remain elevated. And the Fed says, well, we want to bring inflation down to 2%. You can't get inflation down to 2% and have the stock market go up and have rates go down on the 10-year and 30-year. That's not going to happen. The Fed is going to keep going and going until they bring inflation down to that 2%. I think we're going to go into a recession. I feel pretty strong about it. And a lot of people that have said in the past, well, inflation is transitory, they're moving to the camp that we could have a mild recession. I don't think recessions are ever mild, and recessions are not necessarily cured by the Fed's early actions. The Fed can start cutting rates, enacting QE, but still unemployment will go higher. And I've seen that happen in the data in the past. The unemployment rate from last month was 3.6%. And people are talking about the Fed pivoting at this level. I think that that's ill-advised. And there was another person, I'll just kind of go on this because I think it's important. There was another person out there in the Twitter world who's a research analyst who is very well respected. And he claimed that he believes that the market has bottomed, the equity markets have bottomed, and that's possible. And we're moving to the 1982 Volcker moment when he pivoted. Now, the ISM manufacturing just came out today. It's at 52.8. The ISM back in 1982, August of 82, was under 40. It's a big difference. It was contracting for a long time. The unemployment rate went from 5.2% in February of 1980 to that around 10%, just I think it was 10%. And the Fed with Volcker started to pivot after actually about 3 months before the unemployment rate peaked. And that's 30 months. So I think that people are getting ahead of themselves, and that's been talked about. And I think the Fed's going to really clamp down on all of this. So I think that the macro is much different than other periods, and people expecting the Fed to pivot to save them, I think it's ill-advised.
Okay, great. So I'm gonna pull on these threads here and then go back to some of where I was leading to with some of the other questions, but you're getting right to the meat of this, which is great. So you're right. So there's a chart here from your recent Twitter feed that shows that CPI peaked back in February of 1980 at almost 15%. And you said that Volcker pivoted when the CPI dropped to 5.7% 30 months after the peak, right? So it took a long time after the peak of inflation before the Volcker pivot actually happened, right? And you say those people that are calling for a pivot right now when we're not even certain if inflation's peaked yet as measured by the CPI. If it has, it's just done so, right? We don't have that lag that sounds like you're expecting. And then mostly importantly, that the administration and a lot of sort of conventional economists right now are saying, nope, we're not in a recession. Don't worry about those 2 consecutive quarters of negative GDP growth. It's different this time because jobs are so strong, right? And I've talked with some other experts on this program of late that is a very lagging indicator. And of course, if you're watching the tea leaves right now, as the economy is slowing and you have said you're worried that we're entering recession, that can change on a dime. And just to pull up another chart of yours, you said that unemployment in February of 1980 at the peak of the CPI reading was around 6.3%. And that Volcker pivoted when employment was at 9.5%, and it eventually topped almost 11%. So you're basically saying...
You got my numbers better than I do.
Well, I pulled them off in preparation of this. But basically what you're saying is look, we know how this movie plays out, and we're still at the start of it unemployment-wise, right? That you're not going to see the Fed, because it has to slay the inflation dragon, it's not going to pivot here when unemployment is still so low. If we're going to see, some sort of semblance of what broke the back of inflation under the Volcker rules, inflation is probably going to have to be a lot higher here before the Fed feels pressured to pivot, at least by that alone. Did I summarize your position correctly?
I think that again, I think inflation has peaked. I think the July numbers coming out next week will decline. The market probably will respond favorably, thinking the Fed for sure will pivot. But we've also seen some of those inflationary commodities bounce back towards the later part of the month. And I think that's also partly due to the stronger equity markets, the stronger bond markets. I think that you could see the data that comes out for August and September not necessarily go down any bit more than what we see next week. And it may even tick up a little. And I don't think the market's going to respond really well if we start to see an uptick after one down month. The real issue is the consumer, especially the low-end consumer, and companies are going to be affected by high inflation, even if inflation is at 5%. That's a historically high level. And I think that the longer term problem that we're going to have, and why I think we're in a bear market, and it's a bear market that really hasn't seen earnings destruction. The S&P earnings estimates have remained rather high. So I don't think we've seen the earnings problems come back into the frame. And if I remember back in 2000, the Q2 numbers for earnings came out a little better, and it was a big relief for the market, much like what we just saw with earnings and what we're seeing right now with Q2 earnings. It's almost like, oh, better than feared. Oh, great. It could have been worse.
Right.
And
They're still bad,
10%.
just not as bad as we all feared. Right.
But then in October, things got really bad in 2000. And you had some really major companies guiding down just because it didn't bounce back. And maybe all these companies have just, found every penny in the couches of the lobbies of whatever, their offices to throw at a good earnings report this quarter. And look, there's mega cap tech. They have a lot of levers they can pull to increase numbers. That's a stabilizing factor for the NASDAQ especially. But I think you're also, we could be peaking with some of the energy names as well.
All right, so let's just talk a bit about kind of how bad things could get. So you're concerned that, and I'm going to put words in your mouth, but correct them in any way. You're concerned about margin compression, or a profits recession here, as companies are getting squeezed by declining demand, right? As prices get so high that just organic demand destruction begins to go on. Plus, there's the demand destruction that's being actively pursued by the Fed by raising the cost of capital, right? So the cost of financing for these companies is getting more expensive. So both of those kind of compress margins, they decrease economic activity, right? And I believe that that's your concern about why we're heading into a recession here, is because inflation's bringing demand down, but the Fed is actively pushing harder and harder on the brakes, trying to additionally get demand down even further, right? And then there's the whole issue of, maybe this is a policy mistake where the Fed pumps the brakes too hard, and by the time the policy, impact hits in 9 months or however long it takes from now, we could be in a bad recession, and the hitting impact of the delayed impact of what the Fed's doing could make things even worse at that point in time, right? So there's the question of how bad could this recession be, and I think you just said earlier, really aren't that many pleasant recessions. There aren't that many shallow recessions we have to point to. So there's that, and if you could also, in your answer, just address layoffs. How bad do you think they could get? Because that's the magic talisman that the Fed and a lot of the current leaders of the administration are waving to say, don't worry, jobs are really good. But as you and I just talked about, that could change pretty quickly. Do you expect the type of layoffs that we've seen in the past, either in '08 or in the dot-com bust?
Well, I can't speculate that it's going to be as high as those periods, because you actually, there were a couple things that were happening with technology. And technology, in the dot-com bust, you had this boom bust, but everything sort of shifted over to the housing markets, and Greenspan kept rates real low and created another bubble with the housing world. Now, going back to 2008, 2009, the financial crisis, that was of course, the next bubble to burst. But I think you had this huge productivity boom. And I will say, I think it was mainly due to technology and the iPhone and new technologies that were really becoming part of our lives. I mean, if you go back and you think in 2009, okay, we were just coming into the new iPhone world. How many companies grew out of the iPhone on mobile? And you can look at and say, well, Facebook, when they pivoted to mobile, they took off. Uber, all these delivery apps, just so many different things. I don't see that technology boom coming anytime soon. And that, to me, says that the recession can be longer until there's another manifestation of technology that we're going to embrace. The other thing is, again, we haven't seen earnings compress. We haven't seen margins compress enough. And that usually is a longer term, let's say 1 year, 4-quarter, maybe even 6 quarters. And I think that's the same thing when it comes to unemployment. Once you get it turning, it typically keeps going. And I think we're at an incredibly good level at this point. And I just don't see it getting any better. I think it's only going to get worse. And again, it takes time. So I can't speculate on how high it can go, but the Fed will probably hit the panic button at 5%, and it may even go to 6%. And I think that'll be really felt in the markets. And so people are thinking, oh, well, the Fed's going to come in and they're going to pivot. They're going to cut rates. They're already planning. There's probabilities of rate cuts in 2023, and maybe that's going to happen. But what if it doesn't work? What if the Fed's actions don't really do what's happened in the past?
Mm-hmm.
Because you need that longer term earnings slowdown. You need to reset earnings a lot lower, and you don't have technology that's going to bail you out with new innovations, new companies. So yeah, I'm like Mr. Bearish today. I'm sorry, it's Monday. Really sorry about that. But here's the other thing: there are opportunities on the long side to find, and you just have to pick your spots. And there'll be bear market rallies, and maybe we're just going to be in a sideways pattern for a couple of years. And that happened in the 70s. Also, a time when we had very high inflation, political instability, and a difficult situation with oil. So that, I think, is my scenario is we're going to be in a sideways, choppy pattern for possibly the next couple of years.
Okay, which obviously that works well for people kind of with your background in terms of how to invest in trade markets like that. And I do want to get into where you see the opportunity. So we'll get there hopefully in just a couple of minutes. Real quick, you mentioned something that I've sort of been just positing out there in recent videos here, which is that we may investors, the consensus, I would say, amongst the general investing community is that the Fed's going to pivot, and maybe the additional consensus is the Fed will keep tightening until something breaks, and then it'll pivot. But what I've been sort of asking a number of guests, and you just brought this up without me even having to ask you, is may the market actually get what it's hoping for, meaning the Fed will pivot, but the implications of the pivot may not be what the market is hoping for. I think right now the general consensus is oh, the Fed pivots and we're back to happy days again. We know what that script looks like. We've had that for the past 10 years. Rates go down, prices of everything shoot the moon. We're all happy again. We just buy the dip and let it ride. I think you're warning, saying it might not actually work out that way.
Well, let's just remember that the Fed balance sheet, where it is today, and they're doing QT. And I don't see them jumping in and saying, let's do some more QE anytime soon, unless there's something that is absolutely extraordinary. And QE is what the market really wants. They'll be fine if, I just don't think the market will be as reactive on the positive side if we drop rates by 50 basis points from here. But again, I think the Fed's they're going to get cover to continue to hike rates as long as the stock market goes up. So if you really want the Fed to pivot, let the market go down and let unemployment spike and have margins compress and everything else bad happen. And then guess what? The Fed will pivot. But they're not going to pivot at 4,200 or even 4,000 on the S&P. They need to see something blow up or break to make a reactionary move. And of course, one thing you mentioned, whenever I hear the policy mistake, that's always after the Fed does something for a continuous amount of time. And then they say, oh, that last hike was a mistake. The mistake was cutting rates to zero for how many years, a decade, right, and then stimulating they had all the money in the world and throwing it all at the pandemic. And that, I think, that's the policy mistake that our generations are going to have to deal with because of the Fed balance sheet so high. I'm just going down the path of bearishness today.
That's all right. You're
it's
not
only Monday.
Yeah, but don't worry. You're not out on a limb relative to the other experts on this channel. You're kind of in the majority, so don't worry. This audience knows well the mistakes of the past of the Fed.
Well, I also when I do get bullish on things, it's usually when people are the most bearish. And one of the things that I track market sentiment on many different things. I look at market technicals, internals, and so I've caught some of the bottoms in the bounces, and we've had a bunch of them this year, 7 to 12%. This last one I didn't catch so well. I do have longs on there, but unfortunately, I'm set up more short right now. But I can withstand a little pain if I'm right. If I'm wrong, I'll cut it, jump on my sword, and move on.
All right. Well, look, just to give you the credibility that you deserve, the question I've been trying to work my way back to, which we'll get to in just a second, is you publish a portfolio called the Hedgefund Telemetry Trade Ideas Portfolio, and that I believe is up 20% year to date. We'll get to that. You're sort of what's been the secret of the success for that in just a second. But real quick though, back to the Fed and pivoting and whatnot. There is a school of thought out there that says, and I'll give credit to Bill Fleckenstein, who was the first one to raise it on this channel, where he said, if the Fed pivots before inflation is really tamed, and my guess is, well, I'll let you answer, but I'm guessing you think it's going to be a long time before the Fed really truly has inflation under control. Let's say the Fed pivots when inflation, the CPI is back down at 6 or 5 or something like that. That if it pivots, there's a school of thought that that's the point at which it may lose the confidence of the bond market, where the bond market says, you know what, you guys can't fully contain this monster that you created. We don't have any confidence that you're ever going to get it under control anymore. And therefore, we're taking yields higher from here to demand to be compensated for the additional permanent risk that we now see. What do you think about that? Is that something you think might be likely or not likely?
Well, I think I like Bill a lot and followed him for many years, and one of the really, really smart guys out there. I agree. If the Fed does pivot too early, and again, I think that we're going to see a CPI that comes down dramatically from last month. But if everything starts to rise again, that CPI for August could be higher when it's reported in September. And all those people that thought the Fed was going to pivot because of 1 month off the high, I think it's going to be a sad story for them. And look, I would love it to say, okay, we've worked off all the excesses, we've done all the bad stuff that we need to do. The economy's cooled off, and we got a soft landing. But it's very rare that we get a soft landing. And that's another thing. I don't see the Fed pivoting with a soft landing. I think they would be more status quo and leaving rates more unchanged. If the only thing the market has is monetary stimulus, and that's still a very sad reflection of the market. I know that it's liquidity in the market and everything like that, but I think that the market needs to stand on its own and prove that it's worth what it's worth at this level. But one thing, I can look over on my screen over here and roll around me, but I see some of the more speculative tech names going up. Tesla, the semiconductors are still overvalued. DoorDash, PayPal, little names like that. Even the meme stocks are just ridiculous. And until that excess is broken down and people just don't navigate towards those, then I don't think the Fed's going to pivot. And if they pause, that's the same thing as a pivot. And there's been a lot of people that said, "Oh, that'll skyrocket the market." Again, what Bill said, doing it too early. Maybe Volcker was right. He did it after the CPI went down substantially. Maybe he was right that he got the trending CPI lower rather than what these people want now. The market wants is 1 month down and a couple data points lower. I just think it just doesn't fit into my thinking.
Okay. All right. Well, look, let's get to your outlook for where you think the market is headed from here and how you're positioning for it. Real quick though, let's talk about that 27% return year to date so far on that public portfolio that you're sharing. What do you attribute to your ability to outperform the market so extremely, right? This is a year where the markets are down, bonds are down 10+%, or at least have been, and S&P down, I don't know where it is today. It's probably not down quite 20, but it was there. And NASDAQ was down 30 and yada, yada. I mean, 27% is a pretty massive overperformance.
Well, I'm two-sided in the market. I really haven't been. I tried buying bonds at one point. I lost money on it. My hit rate is around 70% of this year, and which I think is, I'm really pleased about that. It's a down year, and one thing that might surprise people is I've traded a lot more on the long side than I have on the short side. I've made more money on the short side than the long side. And that's partly because I have bought, when I buy the long, smaller sized positions. Everything to me is about sizing. And my minimum size is 2% of my assets, and my max is 5%. And the way I look at that, and I talk to a lot of different investors. I have, some really, the more well-known hedge fund managers. I've got pensions. I've got all sorts of mutual fund managers. And then I have a lot of, wealth managers, and then retail investors that have found me on Twitter or wherever. And I have some that are incredibly, incredibly smart. Some maybe smarter than some of the hedge fund managers I talk to. But I feel like I have a responsibility to make sure that I don't blow anybody up in the sense of getting too bullish on something or too bearish on something. I always stress my size. And if I'm, if I'm down 10% on a 5% position, what am I going to lose? And how is it going to really affect someone's month or actually their year or lifestyle? So I care about people a lot, and I want to make sure that the sizing gets done right. And there's a lot of people that are impatient. They want to make money real fast, and that's not me. That's not me at all. I like making money fast. I like when trades go in my favor quickly, but I don't anticipate those. And so if I get them, great. But I think by having it sized right, you can navigate around the market on the long side and short side. And again, I've had a great year. And I mean, last year was pretty good too. But even with the sizing that I do, it's worked. There's not like one giant position that's taken me over the top. It's just it's grinding it out.
Okay, so grinding it out again, 2 to 5% positions. You're not ever saying, I love this idea, I'm going in 40+%, and then potentially having it blow up on you and digging a big hole that's going to be hard to get out of. Totally get all that.
I like sleeping. I mean, I like my weekends.
You're a fan of sleeping well.
Okay, when I went to school in California, and I would. My parents got me one thing for Christmas one year. They bought me a Mac. I didn't even anticipate it. And great, thanks. But I bought a program for blackjack. And I started, just like any college student, I started playing. I became obsessed, and I read all these different things. And I met Ed Thorpe and all these other, statistical type people. Because but as it turned out, I'd go to Vegas and I'd play blackjack. And the same reasoning with sizing was part of the way I would succeed and not blow myself up. A lot of people will, get down, and then they'll say, oh, I'm going to put 25% or 50% or all my money on something and hope they win. And if not, they're going home. So that's kind of where I learned position sizing and how to stay in the game. And that's, I'd rather underperform and be in cash and miss an opportunity than lose money.
Okay, great. So the discipline of position sizing has been key for you, not just this year, but throughout your career. In terms of cash, because you started off this interview by saying that this is a good year to be in cash, how much of that portfolio is in cash where you've still had this 27% return?
Well, there's times where I'm fully invested. I was I'm around 12.5% cash right now. There were several times in the last couple months where I had 50% in cash. And there are a lot of portfolio managers that can't do that. Obviously, they have to be fully invested. But I think if anything, it just shows people my lack of conviction on either the long or short side when I do have a lot of cash. And that's generally it. I can do whatever I want. I don't have a mandate from other people to be fully invested or to do ESG or whatever. I can buy or sell whatever I want. I stay in my core competency. I don't buy Bitcoin. I don't trade anything that I don't quite know. I do have a fundamental background. I do look at fundamentals. I tend to look for liquid stocks. Most of my stocks will be in the S&P, and it's just sort of the way I navigate, and it just fits my own personality and style.
All right. Well, we big part of what we do at Wealthion is we educate people through these videos, and then we connect them with like-minded financial advisors who understand all the macro issues that we talk about on here. And the standard financial advisor, as you said, they don't like to be in cash because they feel like, well, my client can be doing that on their own. And one of the dangers of feeling that pressure is they're always fully invested all the time, which you just said, it's not always the right thing to be. And my guidance for folks is always, hey, you want to, the relationship with the financial advisor is you want them to know when to be in cash, right? You want them to be moving to cash when it makes sense, right? You don't want them to just always be 100% invested all the time for exactly the reasons that you just mentioned there. All right, well, look, so let's get to your general outlook for the market here. If I understood you correctly from what you said earlier, you think we're in a bear market. You don't think the bear market is over. So I guess a couple of key questions. One, how much further down do you think it's likely to go? What are going to be some of those key indicators? I think you mentioned earlier, if we start seeing companies really begin to bring down their guidance maybe in the next quarter or two, that could be another trigger for a big leg down. But how deep do you think this could go, and what path do you think we're going to take to get there?
I think the best case scenario.
Our interview with Tom will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. Oh, and good news. Feedback on last week's pilot launch of Adam's Notes, my summary of the key takeaways from the video interviews I do here each week on Wealthion, was hugely positive. So we're going to keep the practice going. To get my top takeaways from this interview with Tom for free, just go to wealthion.com/AdamsNotes. Finally, if the challenging macro outlook Tom has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Tom has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Thomas Thornton.